Ladies and gentlemen, good morning and welcome to the Cello World Q4 FY25 earnings conference call hosted by ICICI Securities Limited. As a reminder, all participant lines will remain in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal the operator by pressing star, then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Karan Bhuvania from ICICI Securities Limited for opening remarks. Thank you, and over to you, Karan.
Thank you. Good morning, everyone. It's a pleasure at ICICI Securities to host Q4 FY25 results conference call of Cello World. From the management, we have Mr. Gaurav Rathore, Joint Managing Director, and Mr. Atul Parolia, CFO. I'll hand over the call to management for their opening remarks, post which we can open for the Q&A. Thank you. Over to you, sir.
Thank you. And good morning, everyone, and a very warm welcome to our company's earnings call. Joining me is our CFO, Mr. Atul Parolia, and our Investor Relations Advisor, SGA. The results and presentations are available on the stock exchange and on our website. I hope you had a chance to look at it. Financial year 25 brought with it a unique set of challenges that tested industries, economies, and business across the globe. In the Indian consumer space, specifically saw subdued demand environment. However, Cello World, we delivered a 7% year-on-year growth, backed by a healthy business model and resilient margins. We are proactively adapting to the challenging situations in a timely manner and have started making strategic modifications in our product portfolio and distribution strategies. We have added some new SKUs and discontinued a few products which were not performing well in terms of volumes, margins, and ROCE perspective. We have also relooked at our distribution strategies as we see a major shift towards quick commerce and e-commerce. This is expected to bring down share of general trade. We have also tied up with most of the quick commerce players and added products that can do very well in this channel. I am pleased to share that we delivered a healthy performance in Q4, achieving the highest ever quarterly revenue of Rs 589 crores, with a growth of 15% year-on-year, while EBITDA and PAT margins remaining stable at 26% and 16% respectively. This quarter was better as compared to the previous quarters in terms of consumer demand, as well as we continue to benefit from reduction in input costs. Both of these, along with a boost in our glassware, also contributes towards healthy business growth. Additionally, some correction has also happened during this quarter, hopefully leading towards better upcoming months. Our consumer wear business did exceptionally well with a year-on-year growth of 24%. The glass drinkware products manufactured in-house are well accepted by the customers, and we are getting a good response, especially for the quality of these products. Currently, we are pricing these products on par with the import prices and are able to maintain a similar margin profile. As we are passing through a learning curve this quarter, we primarily focus on improving our cost efficiencies and are aiming to reach to about 75% efficiency levels in the next 2 to 3 months. This year, our target is to break even in the glass space as we expect to exhaust our capacity by financial year 27. Similarly, our opalware business also performed pretty well, reaching almost 80% of our furnace that is sold until financial year 25. We hope to exhaust the capacity of this furnace in the financial year 26. There was a change in BIS norms for stainless steel vacuum glass bottles, due to which imports of such products from China has been banned. This resulted in elimination of a lot of unorganized players from the market, and there is a huge gap that I see now, which we'll be able to take advantage of in the longer term. For the time being, we have built up 5 to 6 months of inventory for these products, and have already ordered machines to be used for manufacturing of such vacuum steel bottles in-house. This is a massive opportunity in the long term. As I mentioned, we might see short-term stockouts that could affect sales in the near short term. Now coming to the writing instruments vertical, we continue to face challenges in terms of export demand slowdown, due to which the segment revenue stood at 78 crores as against 87 crores in Q4 last year. However, we see some signs of recovery in demand scenario from exports as well as domestic market and are hoping for things to improve in the coming year. To better manage this situation, we are working towards diversifying our Unomax product baskets by adapting new product lines such as art-related products, geometry boxes, etc. Finally, coming to the furniture business, the performance was in line with the trends of the industry, but we managed to deliver growth of 8%, which is slightly better than the overall industry growth. We are planning to add up some products into this category which can help us grow at a faster rate than the industry. We continue to have a premium approach towards our products and focus on expanding our reach and penetrating deeper into all the states of India. On the back of a strong balance sheet position and healthy operating cash flows, the company is well positioned to grow faster as the demand scenario improves. I will now hand over to our CFO, Mr. Atul Parolia, for the financial highlight. Thank you very much.
Thank you, Gaurav, and good morning to everyone. I am happy to announce that Board of Directors has recommended a final dividend of 1.5 rupee per share, which is 30% of the face value of rupee 5 each for financial year 24-25. Now I will be sharing the financial details for the quarter gone by. In quarter 4 financial year 25, we achieved a revenue of rupee 589 crore and EBITDA of 148 crore with a healthy EBITDA margin of 25%. Our PAT stood at rupee 88 crore with a margin of 15%. Speaking of the revenue mix, over 69% of revenue came from the consumer wear, 13% came from the writing instrument, and remaining 18% from the molded furniture and allied products. General trade channel contributed 77% of the sales, while export and online sales made up to around 9 and 8% respectively. Modern retail, growing at the faster rate, accounted for the remaining 7%. In terms of segment-wise margin, writing instrument led with a 58% gross margin, followed by consumer wear 53% and molded furniture at 42%. Now coming to the financial year 25 performance, revenue was 2,136 crore with a year-on-year growth of 7%. EBITDA stood at 555 crore with a margin of 26%. PAT was rupees 339 crore with a margin of 16%. Our cash flow from operations stood at rupees 262 crore. During the year, we have reduced our entire debt, and as on March 25, we are at net cash position. For the full year, we incurred a capex of around 166 crore, with mainly include investment for the glassware facility. Going ahead, for financial 2026, we expect to do a capex of around 100 crore. Now, with this, I would like to open the session for question and answers.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use their handsets while asking a question. One moment please while we poll for questions. The first question comes from the line of Percy Panthaki from IIFL Securities. Please go ahead.
Hi team, good morning. Can you just give some idea what is the sales from the new plant that you have recorded this quarter?
Right. So I think it's a 20 crore turnover basically because the plant got commissioned in February. It's only 2 months data. So we have doubled the sale over last year for the 2 months. So net it's a 10 crore increase.
Oh, okay. It was 10 crore. Sorry, I didn't understand that because this is a new plant.
So the idea is that, in the first quarter, because we only got about 2 months of selling from the new plant, which was February and March. So basically, for the 2 months, for the quarter, we got a 10 crore increase net in the glassware. So we were doing imports, right, before. Yeah, so those got substituted as well. So that is why net it was a 10 crore increase in the glass segment.
Okay. So I was actually looking at what would be your homeware segment growth adjusted for this new plant, because it's 24% that way. So I was just looking for that number.
From that perspective, you can just minus about 10 crores, and then you would get the growth of the homeware segment overall.
Okay. So that's still a decent double-digit growth, right?
Correct. Of course, absolutely.
Okay, so there has been a significant improvement versus what we've seen in the last 2-3 quarters. So just trying to understand what's the reason behind that. Is that just a pre-sale or a pipeline issue, or there's some real underlying improvement in demand?
So there was improvement in the last quarter for the demand, of course. There is a slight shift, which is why we see a better growth, overall. But of course, it is not a continuous growth. It is just been the last quarter that we've seen this. So it doesn't because the overall year was a little challenging. But quarter was good. Let's hope, it continues.
Okay. And secondly, you mentioned that you have taken some portfolio rationalization decisions. So if you could give some idea that the part that you are rationalizing, what is the annualized sale and annualized EBITDA of that part, so that we can sort of try and understand the impact on the FY26 financials?
No, so the idea is overall rationalization across categories. So, normally we all do an 80-20 kind of a product, analysis. And through that, we found a lot of products that, don't need to be a part of inventory. Because a lot of these products are very similar to our current products. So they're probably cannibalizing sales of other products that are doing very well, because either, we are not producing them, because we are producing the other products, and there are orders that were pending for those particular items. So in effect, it's not really going to hurt any revenue, because at the end of the day, these are products that either become obsolete, or they are products that have just cannibalized other good running products. So I think the rationalization comes from the fact that some SKUs are not needed anymore in the portfolio, and that is why they are being removed. So I think the underlying basis is only that.
Okay. So basically you're saying no impact on top line or margins on account of this. Any impact on working capital or any sort of one-time provision or charge that you will be taking if these items are obsolete?
No, when I talk about obsolete, this is not inventory that is obsolete. These are products that have become old in our portfolio. So there is no inventory hit that we take for this, because that inventory doesn't exist. We are just taking it off our price list, so that we are not offering this to our customer anymore. So that's about that. And in terms of the products, there is of course going to be newer products that are going to come in while we replace these. But if we are replacing, if we are getting rid of 10, we'll probably add only 2. Also, this is from the perspective of the channel as well. That lower inventory in the channel will also help the debtor days come down. So the idea is to kind of cleanse the pipeline as well to a certain extent, where we can bring down our debtor days further.
Percy, have your questions been answered by the management? Since there is no response from Percy, we move on to the next question. But before that, ladies and gentlemen, if you wish to ask a question, please press star and 1. The next question comes from the line of Ankur Sharma from HDFC Life Insurance. Please go ahead.
Yeah, thanks. Good morning, sir, and thanks as always for your time. First on the glassware segment, if you could help us, what was the full year sales in FY25, I think you were earlier guiding to somewhere around that 450 to 470 odd crore number for the full year. And, how do you kind of see this shaping up over the next year or so as you ramp up this new plant?
Right. So I think for the financial year 26, our aim is to reach about 450, 475, around that figure, which will exhaust our glassware capacity, by about 65 to 70%, and we still have some capacity left for next year, which we want to exhaust. So the idea is, to grow this to that level, and plus we have our opalware capacity, which is about 80% utilized, and we would like to exhaust this within this year. So that's where we stand in terms of the overall glassware scenario.
I'm sorry, so what was the number for FY25? Where did you close on last year?
So I think we do not disclose numbers separately for glassware, so I'm not in the position to give you that on the call.
Okay, fair. Second, you spoke about, the stainless steel bottles, with this whole BIS coming through and of course imports getting banned and therefore the unorganized kind of moving out. Could you help us, how large is the unorganized, as per you, what percentage of the market would be unorganized? What would be your share in this segment and, what could be the market share gains that could happen over the coming quarters?
Right. So, stainless steel, of course, is a pretty big category in India, and a lot of sales have been hit due to unavailability of this stock, industry-wide. So, I think even a small retailer would be able to order a container. So, you can see how fragmented the sale actually was. Talking about our numbers, we were about 12 to 13% of this segment, and top three players put together would be about 35-40% of the business, and the rest was unorganized. So I think there is significant gains in the long term that we can expect. But having said that, we will be putting up our facility in the next 4 to 5 months, and in the short term, we might actually see some reduction in sale due to non-availability of this particular item. But in the long run, we have a lot to gain, and even though there will be some OEM players who will also come into the foray, which have already started, but I still feel brands overall will really benefit from this BIS implementation.
And I'm assuming the top 4-5 brands would be the largest gainer, including yourself. That's how we.
Yes, absolutely.
Okay, fair. Just a third question, you spoke about this shift away from GT and, more towards QCom, ECom. So if you could just help us, what would be that share, at this point? How does that affect profitability in a positive, negative way? Just some color there to understand, how it affects our overall business.
Right. So I think online we've increased by about percentage overall. Though it is in percentage terms, it's pretty small. But overall, it has 2 percentage points. We have increased revenue. But in real terms, the quick commerce sale has really helped us, to increase this part. And, going forward, I see a faster growth in these channels compared to GT. So though GT is also growing, it's not that it is not growing, but I think the pace of growth on these alternative channels, quick com, e-com, will be a lot faster. So I wouldn't be surprised if we have 2 percentage point gains every year, in the next coming few years.
Okay. And profitability versus GT?
Profitability, we maintain pretty much similar levels. We do this primarily by, differentiating the product line, online and offline.
Got that. And just last one, if I may, clearly, when I look at the Q4 numbers, and if I adjust for the glassware sales, houseware clearly has done quite well, likely in that low mid-teen kind of growth. So, if you could just help us understand, is this more of channel filling before the summers? Is this real demand pickup and secondaries have also been equally strong? And if yes, which pockets, is this lunch boxes or is it bottles? It's just some more color as to what's driven that growth for us in Q4 and how sustainable, so basically trying to understand as we get into 26, do you think we can get back to maybe the, high single, low teen kind of growth? Yeah, thanks.
So I think, yes, it has been good. Overall consumer wear demand was pretty good actually in Q4. But having said that, we have not seen continuous growth. Even we experienced this growth in the last quarter as well for a couple of months. And then the December month kind of died down a little bit. So we are not seeing consistency here. We are seeing spurts of growth. But that consistency still is not back. So it's tough to, say that we continue on this ramp. But having said that, what we can expect in the houseware businesses, you are right about, at least the high single-digit numbers should be possible and achievable in this coming year. And overall, we think that having glassware also in the portfolio, but, that will be slightly offset by the steel flask demand, but we still expect about a good 12 to 15% kind of growth in the next coming year.
Got that. Great. Thank you. Thank you so much for your time.
Thank you.
Thank you. The next question comes from the line of Grishma Shah from Envision Capital. Please go ahead.
Good morning to the management team and thanks for taking my question. Couple of questions, if you could also help us understand one, the 100 crore capex that we've announced includes the glass, the BIS related product capex also. That is one. Second is the raw material outlook. Those are the first two questions.
So yes, the 100 crore capex includes the steel, the new facility that we are putting, in Rajasthan. So that is a part of it. And sorry, I did not get your second question.
Overall, for the business, what's the raw material pricing outlook for FY26? You said there was some benefit of lower raw material prices in quarter 4 compared to quarter 3. So that, continuing that, what does the outlook look like in FY26?
So I think we are pretty much at our lowest point in terms of raw material prices because due to subdued crude prices. So I believe that the crude prices will continue being like this, and that is why I think the raw material prices will be at this level. So don't see too much of fluctuations. I think it will clearly be at this level for this financial year.
Okay. And, this line, how much time would it take to, come on stream, the steel bottle plant and, will it like take till the end of the year or what does it look like?
So, I think we'll only know once we start. So, I think our idea is to start in the next 3 to 4 months the facility. Okay. And it might take, a few months to stabilize. But having said that, you can start production, but maybe the efficiencies might be low initially. But, it is going to be a learning curve because, we still don't make the best bottles in India as good as China. So, we'll, of course, take some time to get to that quality. But having said that, we are all in the same boat. So no one has an advantage as such. So we'll try our best to make sure we are up and running very quickly.
And in terms of OEM tie-ups, we've not tied up with any OEM in the interim. Is that a stopgap arrangement that we have in place?
Yeah, we have some bottles coming from OEM, but it's very limited because India, the production itself is extremely limited at this point of time. So even the OEM production is going to a lot of people. So it's not only coming to us, it's going to a lot of people. So for that reason, that is why we might see some, gaps that might come in the next few months. We were trying to, plug that gap as soon as possible with our production.
Okay. The other question was on the opalware side. What gives you confidence to exhaust the capacity in FY26, given that there would be a fourth place who would enter, who also is a formidable player in the other categories? So, what are the, positive demand trends that you're picking up due to which you think that the opalware capacity would be exhausted?
No, I think we've taken a lot of initiatives to kind of exhaust this capacity, including some additions to our range. So our idea is, though there is a fourth player entering, I feel until then, and the entry is a little away. It's not going to be pretty soon. I think for this year we are pretty confident of exhausting that capacity out, and I think we're pushing for that pretty aggressively. So I think the idea is to exhaust and be at a good position for next year. Though, of course, capacity additions now have taken a back seat for the time being, but at least exhaustion is our first priority.
Okay. Fine. Thank you so much.
Thank you.
Thank you. The next question comes from the line of Akshat Mehta from Seven Rivers Holding. Please go ahead.
Am I audible?
Yes, absolutely.
Yes, Akshat.
Hello?
Hello? Yeah, sure. Please go ahead.
Sir, I just want one clarification. This BIS norms that have come out for consumer appliances as well, sir. Those BIS norms, a few days back, there was a notification where they said that they have extended the deadline by another year, but till March 2026. So are those norms still applicable for consumer appliances, or what is the scenario there?
No, so consumer appliances actually had the BIS implementation about a couple of years back only. Most of the manufacturing that is happening today is in India. It's not really happening in China anymore. So consumer appliances, the entire bit is actually local now. You're not allowed to import a finished product from China. So that has happened about a couple of years ago. It's not something new.
Oh, okay.
Yeah.
Okay, thank you, sir.
Thank you.
Thank you. The next question comes from the line of Aniruddha Joshi from ICICI Securities. Please go ahead.
Yeah, sir. Sir, I missed the initial part of the call, but in terms of exports of writing instruments, is that the only export suffering, or is there exports in other segments too, and that is also suffering? That is question number one. Also, when do we see the, in a way, export normalization? Means already 4 quarters are over, and we still continue to see decline in the exports business. So what is the outlook here? In a way, means if we are not present in that market, probably we will lose the market share permanently itself. So how are we thinking on those lines?
So in terms of export, our major export actually comes only from stationery and writing instruments. Everything else is pretty meager. It's not, a lot of export in other categories. So writing instruments has, of course, been taking a hit. Having said that, it's not that we are losing markets, because these market demands have dropped, but we are still exporting to all of these markets. So the idea is that, of course, the demand or the numbers have to improve for the exports, and probably one initiative that we have taken is to adding more countries. The countries that we are present in, now we are adding some more to kind of stem this, problems that we are facing in the other markets. So as the demand that there would increase, it would definitely have a positive impact. And the writing instruments degrowth has pretty much probably been because of the exports only. So the export slowdown has really impacted the overall category. While domestic, of course, also did not grow, but it did not decline as well. So there, we actually want to push now domestic demand a lot more, because that's where the growth avenue is more than exports.
Sure, sir. Then secondly, at the time of we had also seen that there are some of the products where we are using the global cartoon character brands on, let's say, on the lunch boxes, etc.
Yeah.
It seems we don't see that anymore. So is that in a way agreement over, or is the company in process to in a way renew that, or means in a way it adds a lot to the branding for a kid products. So what is the strategy further on that?
No, we have actually, we have a renewal of these licenses every year, and even this year we have renewed. What we tend to do is we tend to change the characters. So it's not that some characters you might not see, but there are others that have been added. So that keeps changing as per the demand scenario. So for example, one character might have become popular with kids during the last couple of years. So those are the characters that have been added, and some that have been, are less, popular are being removed. So that is just a rejig. It's not that we don't have licenses in place.
Okay, surely. Understood. And now last question from my side. Post QIP, now the balance sheet is in a way flush with cash, and again the company will also continue to generate a good amount of earnings as well. So what will be the plan with the cash which will get accumulated on the balance sheet? Whether it will be paid out in terms of dividends, or some money may be required in the capex that you indicated earlier. But anything on the cash plans in terms of acquisitions, because media news flows indicated that we were looking for acquire in a way some brands definitely in a way bags or something like that. So any further thinking on those lines?
So I think gone. Yeah. Sorry. So, in a way, basically, the cash, we've always opened to any acquisitions or mergers, that come our way. And having cash on the books is always good, in such a situation. So, though we might be sitting on cash today, if there are good opportunities that come our way, we are quite open to, kind of go that path. Of course, if we don't find any opportunities in the next couple of years, there will be good payouts as well. So I think we are open both ways. We are not shutting down any opportunity that comes our way. Open to everything. But not currently, as I had mentioned last time, we were looking at a potential buyout of a certain player in the plastic segment. That is currently off the table, because when we did the due diligence, we did not find it appropriate, some of the things, and so we took a back seat on that. But having said that, we are still open to any kind of acquisitions in the future.
Okay, surely, sir. And last question. In the previous call, the Q3 call, you had slightly toned down the EBITDA margin guidance. Now, obviously, revenue growth is coming back, so we will benefit from operating leverage. Plus, the key raw material, crude oil, has also in a way gone down now. So logically, glassware plant should stabilize, and it should also add to the profitability as the initial teething issues may get resolved. So any fresh guidance in terms of the EBITDA margins for FY26?
No, I think EBITDA margins I had guided would be subdued because of the glassware itself. Because glassware in the first year, as you know that it takes a little time to stabilize, and even now we are still at only about 55% efficiency levels. So the idea is that we might not see any good profitability overall. We would be able to break even for the year. And that is why, the revenues might rise, but it might not add to the profitability. And that is the reason why I had guided that, the profitability could take a percentage point hit for the year. But having said that, of course, we'll try not to have that kind of a situation. But, just in case, this efficiencies, the earlier we achieve, the better the position will be, of course.
Okay, sure, sir. This is very helpful. Many thanks.
Thank you.
Thank you. The next question comes from the line of Ashutosh Ketan from AMSEC. Please go ahead.
Yeah, hi, sir. I just needed one clarification. The 12 to 15% growth that you said that in FY26 is for the consumer segment, right?
No, this is for the overall company.
Okay. And segment-wise, if you could just break down this growth.
Yeah, so consumer wear would be a little higher at about, 18%, owing to the fact that we are also adding revenues of glassware in this. And with the writing instrument segment, we are targeting about 10 to 12% growth. And furniture as it is at about 7 to 8%. So overall 12 to 15% is the kind of number.
Okay. Got it. That's it. Thank you so much.
Thank you.
Thank you. The next question comes from the line of Akhil Parekh from B&K Securities. Please go ahead.
Yeah, thanks for the opportunity. I have three questions. The first question is on the product which we have discontinued or we are planning to discontinue. Would you be able to highlight which are some of the products, and was the ROCE lower because of the heightened competitive intensity in those products?
Sorry, I didn't get your second question, please.
No, so my first question is whether the product categories which we have discontinued, the ROCs are lower, you have highlighted, right? Was it due to the heightened competitive intensity in those product categories? And what are some of those products? That's my first question.
So I think the returns over time on these product lines, these are not product lines, these are products as such. So for example, if there is a bottle, I am not discontinuing the entire range of bottles. We are just discontinuing, say, 2-3 products from that range. The idea is either they have become older, so they are probably being sold at slightly lower prices. So they are eating up into the sales of the products that are doing better and have higher margins. So that is the reason why we are discontinuing some of these products. Because it brings down the overall margin portfolio, and also it doesn't let the newer product lines, sell as much, because the production capacity for a particular month is only that much. And a lot of these products are very seasonal. Say a bottle is very seasonal. In the summer it sells a lot more than the rest of the year. So I think that is the reason why we want to kind of do this. So ROCEs are one of the reasons. Another reason is also the inventory build-up that happens at our distributor and our channel partners, due to the number of product lines. So we are trying to reduce the number and also, in effect, trying to reduce the inventory that our partners carry.
Sure. And so this will also help us reduce our own inventory, I believe, right? And help us to improve on the working capital.
Absolutely.
And any guidance on the inventory days we expect from this activity?
So inventory base should be at a reducing trend. It is now, currently it is pretty high also because of our steel flask, because we had filled in about inventory of about 6-7 months, which is now coming down. So we should be able to see about 7-8 days or about 10 days of improvement after all of this is in effect. But yeah, you'll see it in a phased manner. You might not see it immediately.
Sure. And my third and last question, the opalware at peak 80% of utilization, what kind of revenues we can generate?
So at full capacity, we are looking at about 400-425 crore of revenue that can be generated out of this plant.
Okay. But that should be 100% plus capacity utilization.
Correct, that's right.
Okay. That's all from my side, and best luck for coming.
Thank you.
Thank you. We take the next question from the line of Karan Bhatelia from AMSEC. Please go ahead.
Hi, good morning. Am I audible?
Yes, absolutely.
Yeah. Hi, Gaurav. Wanted to understand the value volume matrix across categories for FY25. That's the first question.
Right. So I think volume is slightly higher than value. Though, it's very difficult to quantify our products in terms of volume and value because, we trend across a lot of different price points. It's not the right way to look at our product line. But having said that, the volumes have been higher because there has been a little more discounting in terms of value. But only about a percentage point difference. So if it's 7% growth overall, we would be at about 8.5-9% of volume growth. So you can't actually see this number doesn't make sense in our overall scheme of things because there's so many product lines.
Right.
Even say our writing instrument is completely different. Furniture is very, very different. So also raw material fluctuations also makes a lot of difference in this. So not a very good metrics to look at. I think in our portfolio we should always look at only value, which will make more sense.
Yeah. So wanted to understand whether the industry has grown and we've grown better in terms of volumes. So that was the focus. Anyways, on the discounting, you mentioned that, are we, we've seen healthy discounting for the fourth quarter, or are we peak in terms of, discounting?
No, so discounting has been for the entire year. If you see, that is why there is a little drop in your gross profit levels. So it's not been major discounting. It is slight bit of discounting that has happened because of demand pressures. So that has been there for the entire year. It's not only the fourth quarter phenomenon.
Right. And while we're not sharing the opal and glass revenue separately, if you can give me at least the growth X of opal and glassware in the consumer segment for 25%, will be fine.
Yeah. So opalware and glassware grew at about 13% for the entire year.
Okay. And the writing export, what's the quantum and what's the decline for this year? That's it from my end.
So the export is still about 46% of the sale of the writing instrument segment, and the decline is about 20 odd crores, which is the decline that we see in the overall numbers as well.
So I repeat, 46% value in writing was exports, and it grew by 20%.
Correct. 20 crores. So it
20
grew by 20 crores in absolute numbers. Yeah.
Okay. Yeah. Thank you, Gaurav. That was very helpful.
Thank you.
Thank you. We take the next question from the line of Percy Panthaki from IIFL Capital. Please go ahead.
Hi, sorry, I got disconnected while I was asking a question. So just a follow-up on those questions which I asked. So I did the math and I removed that 10 crore from the consumer wear. It is still a 20% growth this quarter compared to the first 9 months, which is like 7-8%. So just trying to understand this very, very sharp acceleration in this segment. What can I attribute this to?
So a couple of factors. Hydration did very well for us due to early summers. So summer, your March sale contributed a lot of hydration sales. So uptake in all channels for hydration, so that kind of did very well for us. And plus, overall, as I said, demand scenario was much better. So these were growths that we were seeing in 22-23. Across all quarters. So I think, having said that, these are spurts of growth and not consistent. So I wouldn't guide on, anything going forth, because the idea is that, it has to be consistent for us to tell you that, this will continue.
Understood. So excluding the capacity addition, how much would you say that the consumer wear division could grow for the full year FY26? Would it still be a double-digit number, if not 20%?
Yeah, absolutely. So as I mentioned, about 16 to 18% it should grow at for the year. Also because we are adding our glassware capacities also.
No, I'm saying excluding the capacity addition, because I want to take a organic basis, which is a reflection of the underlying demand.
Excluding it still could be like low double digits, sorry.
Got it. And secondly, on your writing instruments portfolio, I understand the exports is in decline, domestic is doing well. But when does this equation tilt so that at an overall level you come back to a YOY growth?
So the idea is that, the dependency on exports has to come down a little bit, because we have not seen, green shoots there in terms of growing demand. So while we are adding a few countries, the idea is to grow the domestic market more aggressively this year. So that will basically add to, the growth.
Sure. But do you think it will take like maybe 3-4 quarters more till this portfolio is back in a YOY growth at overall domestic plus export level?
No, I think we should start seeing growth, in the second half for sure in this category.
Understood. And lastly, on furniture, since crude prices are a little soft and there might be either higher discounting or lower pricing of the products, how do we see the value growth of this segment for this year?
So the idea is to, keep selling premium products in this range. So until we are able to increase the share of our premium product lines, we should still see a value growth. You're right in terms of saying that, revenues drop in this category when, the raw material prices come down. But hopefully that will be offset by, selling the premium range.
Got it. That's all from me. Thank you and all the best.
Thank you.
Thank you. We take the next question from the line of Grishma Shah from Envision Capital. Please go ahead.
Yeah, hi. Two quick follow-ups. What has been the cooler category growth for us this summer, given that Q4 also would, help us in that way?
So last year we saw a big surge in cooler demand. This year was very limited. So not really any growth. We are only meeting last year kind of expectations this year.
Okay. And
there was also a lot of inventory by other players in the channel because everyone kind of anticipated it to be very good, but the summer was short-lived. So I think that was another reason.
Okay. So do we also have like more inventory in the system, or we didn't have much?
No, not really. We don't have that much inventory on the cooler bit. We're pretty much sold out on that inventory side. Yeah.
Okay. And the second thing was on the distribution side. If you could highlight, what is the current reach that we have, and how do we plan to expand in the coming year?
So I think in terms of distribution, we're of course there all India, pan-India distribution is there. There are pockets of course that we keep improving, where we feel that our sales are lower than say a competitor or a peer, or we feel that the potential of that particular territory or area is a lot more. So I guess having from that lens, we keep improving it year on year. But having said that, there is no real geographical area that we are missing out on. So I think it's just about addition of more and more or penetrating further in those areas, and also other channels as I mentioned, quick commerce, e-commerce are also helping us reach customers, and penetration is also increasing from that perspective.
Fine. Thank you and good luck.
Thank you.
Thank you. Ladies and gentlemen, with that we conclude the question and answer session. I now hand the conference over to the management for their closing comments.
Thank you so much, everyone. Hopefully we've had a good quarter, and hopefully this momentum continues. That's what we hope, and we hopefully continue to deliver great results. Thank you so much.
Thank you. On behalf of ICICI Securities Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.